Well, hi, everybody. Thanks for joining us on Logistics Executive TV. Today, we're following on a series in the express transport, freight, and especially aviation, with a specialist who has worked right around the world, FedEx, DHL, TNT in the US, Middle East, and APAC. I'm joined again by Matt Daniels. Matt, thanks for joining us.
Thanks, Kim. Nice to be here.
Good stuff. Where are you calling from today, Matt?
Kim, today I have the pleasure of being up in Noosa, which is about 2 hours north of Brisbane. It's a beautiful part of town. Not sure if you've been here.
Many times.
Yeah.
Many times. Absolutely. So, Matt, thanks for joining us again. This time I want to have a bit of a chat. Last time we talked about margin and express right across the whole logistics landscape. I want to talk about today a little bit one step further about what some of the key drivers of growth are and why AI will inevitably strengthen many of the roles in the logistics and transport sector.
Yeah, thanks, Kim. Look, before I dive into how productivity and AI and robotics augment this, I'd just like to make a quick comment on China, Kim. We've just finished Chinese New Year, and It is a powerhouse. Look, in essence, I think most people are aware that China is a three-tiered economy. It's made up of consumer spending, exports, and fixed asset investment. Look, I'll touch briefly on what each one means to the transportation and logistics segment. However, Fixed asset investment is a key driver. It's down at the moment, first time in decades, and that's because China's going through a declining property market. But the good news is manufacturing investment is well up. And that's encouraging, and it supports the capacity to meet global demand. Now, China, I'm not sure if you've seen last year had a record-breaking trade surplus of 1.2 trillion.
I did see that.
Yeah,
that's very good.
That's something that has never happened before. Yeah. And a lot of these exports, I mean, the US accounts for 15%, Asia 47%, Europe 21%, Australia's only 2%. But in perspective, the US runs a global trade deficit of around 900 billion. And that's been up year over year. And that's particularly because of the tariffs. A lot of consumers or importers there in the US have been ramping up volume before the tariff came in.
So in layman's terms there, Matt, that's roughly about a trillion with a T.
Yeah, that's right. It's very close to a trillion as a deficit.
Yes.
Yeah. I mean, in the past 5 years, Kim, China has had a 40% increase in their exports and only a 1% increase in their imports. And the exports are mainly made up, as we know, of electronics, textiles, machinery. They're still the world's largest producer of steel. This is a major trade surplus for China, and it has significant impact on express carriers because there's the burning question there. How do you manage the round-trip profitability of a flight, which is low in margin and volume on the inbound into China, but it is constrained on the outbound because of the imbalance, the trade imbalance. So China is so significant. Any incremental change in this will have an impact on cost. I think it's worth noting too, Kim, there's been lots of trade deals now that are being done with China. EU is the space to watch. They were running an increasing trade deficit with China. They made it clear, more access into the Chinese market. Thank you for machinery, cars, pharma. They just signed a new trade deal, as has Canada. And this is important because the more trade deals that are done with China will transpire into more inbound volume, more access into their market, and that hopefully will even out the trade imbalance. So in summary, in the past 10 years, China has contributed 3 times more to the world GDP growth than the US. And in fact, this year, their contribution to world GDP growth is forecasted at 26%, which is more than the G7 countries combined. And that is an amazing statistic. They are, yes, the number one emitter of carbons, but they're also the number one producer of sustainable power. So this focus on low-cost energy, and I don't know how it is there in Dubai, Kim, where you are, but here in Australia, we've seen 20-30% increases in our energy bills. The enormous amount of energy, for example, that a data center uses, to produce chips, cars, and everything else. China's well positioned in that respect.
Okay, brilliant. That's a hell of a dump, Matt. You've clearly been doing the research, and I know that you're consulting a bunch of tier one companies around the world, especially in APAC. So it doesn't surprise me you've got all that information at your hand. Look, you've worked across, as I said earlier, a lot of the big carriers, and one that we both are working at times, the TNT Express, which went on to be SEVA and has evolved onwards as a global powerhouse. What are some of the big key impacts that you're seeing at the moment as we dive into 2026?
Well, what I see is that the express companies are on slightly different trajectories in the market, and as you can see from the slides, DHL shares actually are up 44% over the last year and 17% over the last 3 months. They have they have as an organisation really good synergy and collaboration between their DGF Express and supply chain divisions, which is now, by the way, one of the leading companies in robotics, up there with Amazon. If you go back 10 or 15 years, people would say that those three divisions were co-opetition, but they're much better at now actually being able to align, and not just in Europe, but also through the US and Asia. So they do have all three divisions really, really ramped up, great market share. FedEx is up by 48% over the last year. I wish I could say that was all due to me, but they are holding that up. That growth is still continuing over the last 3 months, which is phenomenal. Their focus has been and is still on high value B2B and profitable B2C. They're not really that interested in the $10 t-shirts. What they really want to do is be able to serve the business community and be profitable, which they are as well. They're spinning off their freight division in the US at the moment into another public company. This is the largest LTL carrier in North America, and they're continuing in investing in smart technology. And generally, it's outperforming market expectations. So they're from an organization's perspective, they're quite strong there in terms of shares and profitability.
Sure.
I'll just touch briefly on UPS. It's really seen limited growth over the last 5 years. However, it has picked up 28% in the last 3 months. Though in the US in particular, they seem to run into a lot of Teamster issues fairly regularly, and their focus is on cost reduction, and they're pulling down about 10,000 drivers due to lower drivers and profitability pressures. But their outlook for 2026 on their earnings report, etc., looks pretty strong. And they sold 90-something buildings last year, and they're reinvesting some of this capital through automation in other facilities. So what they'll do is they'll automate these facilities in areas that aren't, and this will particularly pull down their cost through the last mile. So a last mile, as we know, is really an expensive part of that business. Yeah.
Right. Those numbers are incredible, Matt. I've really got to keep up. I mean, that's 40s, 50% growth in share price. I mean, I know that the markets in the US and everywhere else and pretty much the world have been very strong over the last 12 months. For a range of reasons. We might talk about those another day. But, of course, UPS, you mentioned about selling property, which is very strong strategy right across the supply chain. We're doing a lot of work in property at the moment on our M&A side and our consulting side with the cold chain globally, which is going through major consolidation globally and in this part of the world. So it's amazing. We're also seeing share price increase in technology. Of course, in your part of the world, one of the world's, if not one of the fastest growing technology companies across the logistics ecosystem being WiseTech, which Richard White started back at about the same time we started, about 26 years ago, in the same street, actually, in Sydney. Share price just came up, I think, today or yesterday by about 11%. Don't know whether you followed that.
Yeah, I have. They've had their ups and downs. I think, technology stocks at the moment, as you can see, are taking a little bit of a hit. People are waiting to see the $800 billion that companies like Meta and Google have invested. over the last year. They're waiting to see what are they going to get back from that. So what's that space? And I think once they start to sniff a little bit of success, I think that will only increase the the amount of investment into AI and data centers in particular.
Yeah, brilliant. A couple other quick ones I want to hit you on, Matt. Just quickly, AI, robotics, everybody's talking about it. And, is it that simple to replace people with AI and robotics in the logistics area, especially express freight?
Well, look, robotics are becoming more prevalent. There's about 4.5 million industrial robots in the world at the moment. Half of them are in China. However, interestingly, if you look at the number of robots deployed relative to the number of workers, it's not China. It's actually South Korea, it's Singapore, it's Germany at the top. China is way down the list below Australia. So whilst China has the most robotics, its deployment is still limited, and they're getting cheaper, Kim. They estimate that there'll be roughly around about 16 million industrial robots by 2030, which is 4 times where we are now. Yes, I think in terms of my concerns, well, if we just go back to the question, can you replace someone? I think AI in the short term will augment jobs rather than actually replace them. And what we're seeing is lots of media, reports from experts predicting doomsday scenarios, stock market crashes. But what we will see is companies working very closely with technology to see how can they improve profitability and leverage the AI and robotics. I think if I talk AI, it's a bit difficult to explain. If I say AI and robotics, people tend to sort of get a little bit more of a grasp of what they can and can't do. But to me, improving productivity is simple. You can't grow a business. You can only grow people. And this is where the term augmenting comes into play. Having the right talent, investing in the people, development, coaching, etc. All of the stuff that we do now, if you can retain the top performers, you'll be more successful. And if you can translate this to a positive outcome and leverage all the AI tools coming into play, that's success, right? AI is not a magic pill. You can't take it and everything will be okay. If everyone else has it, how do you differentiate yourself in the market? And if we get rid of everyone and we just have AI, who's going to do the fact checking? That's the question I have.
Exactly. Well, of course, AI can check on itself. I mean, but at the end of the day, you're right. I mean, we're regularly talking to hundreds of companies around the world, various offices about these issues and doing surveys as well, which we're posting on LinkedIn. And, the demand for talent keeps on growing, if only the talent pivoting to the areas of needing to have AI capabilities and understanding what's behind the decision-making taking place as well. But this year started, I've got to say, stronger than any other year over the last decade in terms of talent demand, right across APAC and the Middle East in particular. So seems to be no concerns there.
Yeah, look, I mentioned 14,000 jobs from Amazon because they've cut it to invest in AI. I mean, look, 14,000 jobs in the US is nothing, right? It's only because it's Amazon that people are picking this up. I mean, if you look at implementing AI into any business, I think to me, the big one is that the best ideas and innovation come from the people performing the task. Now, will employees work with the company to identify AI opportunities? Because at the end of the day, that may eliminate their role. So if not, how are we going to manage this process? So people are still very much uncertain about AI, and of course, the accelerated pace of robotics becoming more self-aware with perfect consistency and precision. If I look at where it is in the transportation industry right now, yes, okay, there are robotics that are loading and unloading, containers and trucks, but where it's more prevalent is obviously in the warehousing space and inventory management. And so if you look at companies like DHL Supply Chain and others, their trajectory is much steeper than what you'll see in other areas. I talked about the final mile. Everyone says, well, look at drones and look at bots that go down the road and deliver. We're not quite there yet. That if
Okay.
once that happens, once we're able to implement, robotics to AI that are self-learning, that can manage those sort of last mile transactions, that's when the cost of a shipment will fall significantly.
Brilliant. Matt Daniels, global expert, especially around the areas of express, margin, latest trends and what's going on the whole logistics field, especially around the APAC particular area. Thanks for joining us again, Matt. If I've got my timing right, you've probably just got a bit of time to get out on the surfboard before it's shark feeding time in Noosa. So by all means, head down to the beach, keep the tan up, and we'll talk again soon and continue the series.
I will do. Thanks, Kim.
Okay, swim between the flags.
I'll try.
Thanks, Matt.